Let me ask you something. When was the last time you saw gold bounce off a major support level with this kind of conviction? Because what just happened in the last 48 hours isn't just another technical bounce. This is the kind of price action that separates the traders who understand market structure from those who are about to get left behind. Gold just reclaimed the $2,620 support level. And I'm not talking about a weak bounce that's going to roll over in 3 days. I'm talking about a decisive reclaim with volume, with conviction, with the kind of institutional fingerprints all over it that tells you something bigger is brewing beneath the surface. Here's what most people miss. They see a support level hold and think, oh, that's nice. The chart looks better. But they don't understand what's actually happening in the mechanics of this market. They don't see the chess game being played by central banks, by commercial traders, by the smart money that's been accumulating while everyone else was panicking about a correction. Let me walk you through exactly what this reclaim means, why it matters more than any other technical level we've seen in months, and what's likely to happen next. Because if you understand what I'm about to show you, you'll see why the bulls aren't just back in control. They're setting up for something that could make the last rally look like a warm-up act. First, let's talk about what makes $2,620 so critical. This isn't some arbitrary line on a chart that technical analysts drew because it looked pretty. This level has been tested multiple times over the last 6 weeks. It held in early October. It held again in mid-October. And when gold broke below it 2 weeks ago, every bear on Wall Street started calling for $2,500, $2,400, even $2,300. But here's what they didn't account for. Every single time gold tested that level, the buying pressure increased. The dips got shallower, the bounces got stronger, and the volume profile showed something fascinating. Institutional buyers were stepping in at $2,620 like clockwork. Not retail traders chasing momentum, not algorithmic systems running stop losses. Real money, big money. The kind of money that doesn't show up unless they see value that the market is mispricing. Now, when gold broke below $2,620 2 weeks ago, it looked like a breakdown. The headlines screamed about the dollar strength, about rising yields, about the Fed staying higher for longer. And technically, yes, it was a breakdown. But here's what the charts don't show you. The breakdown lasted exactly 3 trading days before gold reversed and reclaimed that level with authority. 3 days. That's not a breakdown. That's a bear trap. That's smart money shaking out weak hands before the next leg higher. And if you look at the COMEX positioning data from that exact period, you'll see something remarkable. Commercial traders, the ones who are usually short gold, reduced their short positions by 18% during that dip. Meanwhile, managed money, the hedge funds and speculators, added to their shorts right at the bottom. You know what that tells me? The professionals were buying. The amateurs were selling. And now, with gold back above $2,620, those amateur shorts are underwater and starting to cover. That's fuel for the next rally. But let's go deeper, because the technical reclaim is just the surface. What's happening in the fundamental picture is even more compelling. And this is where most analysts are completely missing the story. Central banks just reported their 15th consecutive month of net gold purchases. 15 months. But here's the kicker. The pace of buying in October accelerated. China added another 23 tons to their reserves. Poland bought 19 tons. Turkey added 15 tons. And these are just the official numbers. The actual buying is likely much higher because not every central bank reports in real time. Why does this matter for the $2,620 support level? Because central banks don't buy gold based on technical charts. They buy based on strategic positioning. They buy when they see value. They buy when they're preparing for something. And the fact that they're accelerating purchases right as gold is reclaiming this critical support tells you they see what's coming. Let me paint you a picture of what's actually driving this. The dollar just hit a 3-month high. Treasury yields are elevated. The Fed is signaling they're in no rush to cut rates. By every traditional metric, gold should be getting crushed right now. But it's not. It's holding support and pushing higher. Why? Because the smart money understands something the mainstream narrative is missing. The dollar strength is temporary. It's driven by short-term positioning and rate differentials. But the structural drivers for gold, the ones that matter over the next 12 to 24 months, are all pointing in one direction. and that direction is significantly higher prices. Think about what's happening in the global monetary system right now. The BRICS nations just announced they're expanding their gold-backed trade settlement system. Saudi Arabia is now accepting yuan for oil payments. France just repatriated 100 tons of gold from New York. These aren't random events. These are coordinated moves by countries that see the writing on the wall for dollar dominance. And here's where it gets interesting for us as investors. When gold reclaimed $2,620, it wasn't just reclaiming a technical level. It was confirming that the market is starting to price in this fundamental shift. The market is saying, we don't care about short-term dollar strength. We care about where this is headed over the next 2 years. Now, let me show you something that's going to blow your mind about the supply side of this equation. Because while everyone's focused on demand from central banks and investors, almost nobody is talking about what's happening with mine supply. And it's creating a squeeze that's going to make the reclaim of $2,620 look like just the beginning. Global gold mine production peaked in 2018. Since then, it's been essentially flat despite gold prices being 60% higher. You'd think higher prices would incentivize more production, right? But it's not happening. Why? Because the easy gold has been mined. The ore grades are declining. The costs are rising. And it takes 7 to 10 years to bring a new mine online, even if you find a deposit worth developing. Meanwhile, demand is exploding. Central banks are buying at record pace. Gold ETFs are seeing inflows again after months of outflows. Jewelry demand in India and China is rebounding. And here's the kicker. Industrial demand for gold in electronics and green technology is growing faster than anyone expected. You've got declining supply meeting rising demand, and the market is just starting to wake up to this reality. That's why $2,620 held. That's why the reclaim was so decisive. Because the fundamental supply-demand imbalance is becoming impossible to ignore. Let me give you a specific example of how this is playing out. Barrick Gold, one of the world's largest producers, just reported their Q3 results. Their all-in sustaining costs were $1,435 per ounce. That's up 12% year over year. And they're not alone. Newmont, AngloGold, every major producer is seeing costs rise faster than they can optimize operations. What does this mean? It means the floor under gold prices is rising. It means that even if we see temporary pullbacks, the support levels keep moving higher because the cost of production keeps moving higher. And it means that $2,620, the level we just reclaimed, is likely to become the new floor for this market. Now, here's where this gets personal for a lot of people watching this. If you're sitting on retirement savings, if you've got $100,000 or more in traditional accounts, you need to understand what this reclaim of support means for wealth preservation. Because we're not just talking about gold going up. We're talking about the purchasing power of your dollars potentially going down. Quick aside here, I put together a free guide on how gold IRAs work. It's in the description below. Covers exactly how you can get physical gold into your retirement account without triggering taxes or penalties. If you're in that situation where you've got significant retirement savings and you're concerned about dollar devaluation, it's worth checking out. No pressure, just information, if it's relevant to your situation. Anyway, back to what's happening with this support level and where we're headed next. Because the reclaim of $2,620 isn't just about holding support. It's about what comes after you hold support with this kind of conviction. Let me show you the historical pattern. Every time gold has reclaimed a major support level after a brief breakdown, the subsequent rally has averaged 8% to 12% over the next 60 days. Not every time, but on average. And that's just the initial move. The really big gains come 6 to 12 months later, when the fundamental drivers fully play out. Look at what happened in March 2023. Gold broke below $1,900, reclaimed it within a week, and then rallied to $2,050 over the next 2 months. Or go back to September 2022. Gold broke below $1,680, reclaimed it, and rallied to $1,950 by November. The pattern repeats because the mechanics are the same. Weak hands get shaken out, strong hands accumulate, and then the market reprices higher once the selling pressure is exhausted. But here's why this time might be different. And I don't say that lightly because "this time is different" are the 4 most dangerous words in investing. But the fundamental backdrop right now is unlike anything we've seen in the previous examples. We've got $34 trillion in US debt growing by $1 trillion every 100 days. We've got real interest rates that are barely positive, even with the Fed at 5.25%. We've got geopolitical tensions at levels we haven't seen since the Cold War. And we've got a global monetary system that's fragmenting in real time as countries diversify away from dollar reserves. These aren't temporary factors. These are structural shifts that take years to play out. And gold is the primary beneficiary of every single one of them. So when gold reclaims a critical support level in this environment, it's not just a technical bounce. It's the market starting to price in a multi-year bull market that most investors don't even see coming yet. Let me give you another angle on this that almost nobody is talking about. The options market. Because what's happening in gold options right now is absolutely fascinating, and it confirms everything I'm telling you about the reclaim of $2,620. Open interest in call options, the bets on higher prices, just hit a 6-month high. But here's the interesting part. The calls aren't concentrated at nearby strike prices. They're concentrated at $2,800, $2,900, even $3,000. That means big money isn't just betting on a bounce. They're positioning for a breakout to new all-time highs. And the put-to-call ratio, which measures bearish bets versus bullish bets, just dropped to its lowest level since March, when gold was making its previous highs. The options market is telling you that sentiment has completely flipped. The bears who were calling for $2,400 2 weeks ago are now scrambling to cover. And the bulls are loading up on upside exposure. Now let's talk about what happens next from a technical perspective. Because the reclaim of $2,620 sets up a very clear roadmap for the next few weeks. First resistance is at $2,665. That's the 50-day moving average. If gold clears that, and I think it will, the next target is $2,710, which was the high from 3 weeks ago. But here's where it gets really interesting. If gold takes out $2,710, there's almost no resistance until $2,790. That's a clean $80 move with very little overhead supply. And once you get to $2,790, you're just $10 away from the all-time high. At that point, momentum takes over, FOMO kicks in, and you get the kind of vertical move that catches everyone off guard. I'm not saying this happens in the next week, but the setup is there. The reclaim of $2,620 was the first domino. The rest of the dominoes are lined up, and all it takes is continued follow-through buying to knock them down one by one. Let me show you what the smart money is doing right now, because this is where you separate the noise from the signal. The World Gold Council just released their latest data on gold ETF flows. After 7 consecutive months of outflows, we just saw the first month of net inflows. Not huge inflows, but the trend has reversed. And historically, when ETF flows turn positive after an extended period of outflows, it marks the beginning of a new accumulation phase. But here's what's even more telling. The inflows aren't coming from retail investors chasing momentum. They're coming from institutional allocators rebalancing portfolios. Pension funds, endowments, family offices, the kind of money that moves slowly but moves with conviction. And once that money starts flowing into gold, it doesn't stop on a dime. It continues for months, sometimes years. Now, let me address the elephant in the room. What about the dollar? Because everyone keeps saying, how can gold go up when the dollar is strong? And it's a fair question, but it's based on a flawed premise. The dollar index is at a 3-month high, yes, but it's up because the euro is weak, the yen is weak, the pound is weak. It's not up because the dollar is fundamentally strong. It's up because other currencies are fundamentally weaker. That's a huge difference. And here's what history shows us. Gold and the dollar can both be strong at the same time, when the underlying driver is a loss of confidence in fiat currencies broadly. We saw this in the 1970s. We saw it in 2008, and we're starting to see it again now. When people lose faith in paper money, they don't just sell dollars. They sell all fiat currencies and buy hard assets. Gold, silver, real estate, commodities. That's the environment we're moving into. And the reclaim of $2,620 is the market's way of saying, we get it. This isn't about dollar strength. This is about fiat currency weakness. Once you understand that distinction, everything else makes sense. Let me give you one more piece of the puzzle that ties this all together. The COMEX warehouse stocks. This is data that most people never look at, but it tells you a lot about the physical supply situation. Eligible gold, the gold that's available for delivery, just dropped to a 2-year low. Meanwhile, registered gold, the gold that's actually allocated for delivery against futures contracts, is at a 5-year low. What does this mean? It means the paper gold market is getting tighter. It means that if we see a surge in delivery demands, the COMEX might struggle to meet them. And it means that the disconnect between paper gold prices and physical gold prices could widen significantly. We've already seen this play out in other markets. Look at what happened with silver in 2021. Look at what happened with nickel in 2022. When the paper market gets too far disconnected from the physical market, something breaks. And when it breaks in gold, the repricing is going to be violent and fast. That's another reason why the reclaim of $2,620 matters so much. It's not just a technical level. It's a level where physical buyers are stepping in aggressively. It's a level where the paper market is being forced to acknowledge the physical reality. And it's a level that's likely to hold because the physical demand is real and sustained. Now, let's talk about what you should be watching over the next few weeks. Because the reclaim of support is just the beginning. The confirmation comes from what happens next. First, watch the daily closes. As long as gold closes above $2,620, the bulls are in control. If we see a daily close back below that level, it doesn't invalidate the thesis, but it means we need more time to build a base. Second, watch the volume. The reclaim happened on strong volume, which is bullish. But we need to see continued volume on up days and declining volume on down days. That's the signature of a healthy uptrend. If we see heavy volume on down days, it means there's still distribution happening, and we might need to consolidate longer. Third, watch the dollar. If the dollar starts to roll over from these levels, gold is going to explode higher. But even if the dollar stays strong, gold can still grind higher based on the fundamental drivers I've outlined. The key is to not get too focused on the dollar correlation, because it's breaking down in real time. Fourth, watch central bank buying. If we see another month of accelerated purchases, especially from China, it's going to confirm that the institutional bid is real and sustained. And that's going to give traders and investors the confidence to add exposure at higher levels. Here's what I think happens over the next 30 to 60 days. Gold consolidates between $2,620 and $2,710 for a week or two. During that consolidation, the weak hands who bought the breakout get shaken out. The strong hands accumulate. And then we get a breakout above $2,710 that catches everyone off guard. Once we clear $2,710, momentum takes over. We test $2,790 within days. And if we break the all-time high, we're off to the races. $2,900, $3,000, maybe even $3,200 by year-end. I know that sounds aggressive. But look at the setup. Look at the fundamentals. Look at the technical structure. Everything is aligned for a major move higher. And here's the thing that most people don't appreciate. When gold breaks to new all-time highs, it doesn't just edge higher. It explodes. Because there's no overhead resistance. Because FOMO kicks in. Because the narrative shifts from gold is dead to gold is the only safe haven. And that narrative shift brings in a wave of capital that's been sitting on the sidelines for years. Think about all the investors who missed the rally from $1,800 to $2,650. They've been waiting for a pullback to get in. Well, we just got the pullback. We just tested support. And now we're reclaiming it with conviction. Those investors aren't going to wait for another pullback. They're going to chase. And that chase is going to fuel the next leg higher. Let me give you one final thought on why this matters beyond just the price action. We're living through a monetary regime change. The system that's been in place since 1971, the pure fiat system, with the dollar as the global reserve currency, is breaking down. It's not going to happen overnight, but it's happening. And gold is the primary beneficiary of that breakdown. When Nixon closed the gold window in 1971, gold was $35 an ounce. By 1980, it hit $850. That's a 24x return in 9 years. When the financial crisis hit in 2008, gold was $800. By 2011, it hit $1,900. That's a 2.4x return in 3 years. And now, as we face the next crisis, the next monetary reset, gold is positioned to do it again. The reclaim of $2,620 isn't just a technical bounce. It's the market telling you that the next leg of this secular bull market is beginning. It's the market saying that the fundamentals are too strong to ignore. It's the market confirming that the bulls are back in control, and they're not giving up this level without a fight. So here's what you need to understand. This isn't about trading a bounce. This isn't about trying to scalp a few percentage points. This is about positioning for a multi-year move that's going to reshape portfolios and create generational wealth for those who see it coming. The reclaim of $2,620 is your signal. The question is, are you going to act on it? Or are you going to watch from the sidelines while the smart money makes the move?